Good morning. This is Michele Zaragoza, team leader for Central Valley KW. I have today Marissa and Terry Nevis, and we're going to chat a little bit about what's going on in the market.
Oh, in the other room?
Okay, cool. Actually mute. We're going to talk about what's going on in the market with VA and also non-owner occupied. First of all, I want to say thank you to you two. You guys are always coming from abundance. Let it be, helping us out with our red day. You guys were both there, roaming around and roaming around. So that was really, really nice. And your support with our loan officer, with our agents, with your other loan officers and getting things closed. So I really appreciate that. It seems like you always come from abundance. And thank you. Thank you. Thank you. Thank you.
Well, thank you, Michele, so much for inviting us on. We're super excited to be able to even talk about our veterans. I'll let Terry get into the non-owner updates in just a little bit here, but to be able to talk about our veterans, we've actually had a lot of phone calls lately, just asking questions. And what I'm seeing is VA home loans, you guys, over the last 10 years have had a serious bad reputation. And I don't know where it came from. But it's one of the best programs that are out there for our client. It not only protects the buyer when it comes to the fees, but it allows them to be able to be in a position that makes home ownership affordable for them. And there's so many different layerings that can go behind a VA loan that really help strengthen it. But it all comes down to really an agent understanding VA financing, what its benefits are, and what to expect during the process, and then really just spreading the word out, and that good solid communication when it comes to communicating when you're negotiating your contract and how everything works. Things that have given a VA home loan bad reputations. Number one is the appraisal turn times. Appraisal turn times are average on 10 days. There's no difference than an FHA conventional appraisal. VA has its specialty panel that it's ordered through. So they have VA appraisers that are allocated just specifically for VA that don't do other types of appraisals. So the turn times are sometimes a little bit faster, and they've gotten a lot better over the last 5 years with VA turn times. The section 1 and 2 requirements, those are things that are going to have to be addressed. They do have to have a termite report. So when you're writing your contract, the things that how you structure the file for your contract is what's going to be really important. You need to ask for a termite report. That has to be done. It's not something that the buyer can pay for. It's something the lender or the seller will typically pay for. But there's ways to structure the loan that will help with the allowable and non-allowable cost. And that is another thing that has really impacted VA financing and something that has affected the way VA financing is looked at, the allowable fees and non-allowable fees. But it's all on structure, you guys. I can't preach that enough. There's ways around how to structure the deal to make it work. And that's why I was invited on to kind of talk to you a little bit about that and how to structure a VA loan to make it work. So let's talk about VA financing altogether. It's 100% financing. There's no mortgage insurance. You have your taxes, your insurance, so there's no down payment. There's layering programs for first-time home buyers like CalHFA, GSFA grant programs that can go behind that 100% option. So our client is virtually coming in with little to no money down at all. And in today's market, that's huge. The reason why is because of everything that's going on with the appraisals and how that's worked for. There's no loan limits anymore. There used to be a loan limit for VA financing. Now we can go 100% all the way up to jumbo type financing. There's no loan limits at all for VA. It's a really, really strong program. The interest rates are almost a point better than conventional programs, and the DTI, the debt to income ratio requirements, are a lot higher. So a client, if you're going to put them away a conventional loan, an FHA loan, a VA loan, USDA loan, even a VA loan is the best program overall for a client. The non-allowable fees and how that works, lenders used to ask for like just say a 2% seller credit that'll cover all allowable fees. You don't have to do that anymore. That's not something that's needed. And the reason why is because on how you structure the loan. A lender can charge a maximum of 1% origination fee. And in that 1% origination fee, the lender can cover all of those costs. Well, the pricing of the average price of a house is, is 400,000 right now. So, $4,000 is going to cover all. Lenders don't charge origination fees. Direct lenders don't. They charge their processing, their underwriting. That's enough to cover the escrow fee, the appraisal fees. So virtually what the lender charges in their 1% origination fee will cover all of the cost, and the seller won't have to pay those types of fees. And that's how it's all on structuring the deal to make it work. It's important that when you go in to submit your offer, you have the cost estimate ready. So you're working with your lender to know exactly how to structure that deal to make it work, so there's no issues later on. But it's a really easy program, you guys. There's no extra time that's needed in it. It's processing just like a conventional and FHA loan. Reserves, clients that are in the reserves for at least a six-year period consecutively, they qualify. Even spouses that have lost their husband or their wife in active duty, they still qualify for VA financing. All you have to do is have active wartime for a minimum of 90 consecutive days, and you are eligible for VA. And the best part about VA, you guys, not only the 100% financing that you have, is there's 18 million veterans in the United States. That's a lot of people. And there's a lot of referral source. So Elk Grove, I don't know if you guys knew this, but the VFW in Elk Grove, that's their main headquarters. And there's a huge referral source there in which you're able to see the monthly calendars on what's going on in the community, how to get involved, and really be able to reach out for lead generation on a bigger scale to be able to get more clientele. And our veterans, they have good jobs. They're firefighters, they're correctional officers, they're teachers, they're people with that type of background. They have really good jobs. They're really strong buyers, really good credit scores. And being able to give them the additional benefits is really important. So that's mainly how the VA financing is working right now. There's a variety of programs that are available with VA, especially if you're the first time home buyer. Like I said, CalHAFA, they're going to be able to get you not only 100%, but they'll give you money for down payment. So it's just going to make your overall financial situation better. There's the mortgage credit certificate programs that'll give you 20% of the interest every year for the life of the loan. That's additional income you can use for qualifying if you're a first time home buyer. It's an amazing program. It's equivalent to a little bit over one payment a year that it pays for you to be a first time home buyer that you can utilize with VA financing as well. If you're active duty, this is someone, an actual Keller Williams agent had asked us last week. If you're active duty, they get housing allowance on their pay stub. That's something that they are allowed to use. It's something that is continued. It's continued pay. That's something that they're allowed to use. It's additional income that we're able to qualify. So there are certain types of income that we can use additionally to help them qualify for more of a home. And the debt to income ratios are so much higher on those types of programs. So the cash flow altogether, the lower closing costs for the client, they'll have more money to be able to come in with in this weird type of market that we're in with having to pay the difference in appraised value. It's something that a veteran can do. They can pay the difference in appraised value. But really what we're seeing most is not having those loan limits. Those are really, really helping a buyer situation. Do you guys have any questions about VA financing?
Yes, I do actually. I have my next door neighbor, her father is VA and she owns a home. And she said, can he buy another house even though he already has a VA home?
Yes. So there's an eligibility requirement, and they can, as long as they're within that eligibility, so we get their certificate of eligibility, we're able to check those things out, and we can see how much they can purchase, how much is left for their eligibility to be able to purchase.
But if there's no loan,
Okay,
does that make a difference?
Can you say that again, Jim?
No loan limit?
The loan limit?
Yeah.
There's no loan limit on VA financing.
Okay. But, maybe I'm confused because if there's the eligibility and then the loan limits. So, I mean.
Right. As far as the eligibility goes. Terry?
Yeah, and Jim's, what she's trying to tell you is a veteran has a certain amount of eligibility that's allowed. So if they bought a home 10 years ago for 200,000, he still may have another 280,000 available to be able to purchase another home.
So it depends on what their current loan balance is.
Yeah, and he doesn't have, are you asking if can he have two VA loans at once at the same time?
Yes, that's what I mean. Mhm.
Yeah, there's an eligibility check sheet that we do to see how much of a VA that he would be able to buy. If he currently has a loan on his house that is a VA loan, then there's an eligibility checklist that we do to see how much of his eligibility that he would have. It may be about 280,000.
Isn't the requirement though that you have to live in the property? So they would have to refinance out of their original one into maybe a conventional loan in order to purchase VA because you have to use that as your primary residence. Isn't that correct?
and how
You
long would that
have-
be?
Yeah, you can't, nobody's going to mandate that you have to refinance that current house.
But
Okay.
yes, it is for owner occupied.
When
So-
your intent when you bought the house has to be owner occupied.
So when a lender goes in and they see you have a current VA loan and you're looking to purchase another VA home, they're just going to want a letter of explanation of what you're doing with your current home. And every such scenario is different. So, I mean, we're not going to, if you were to apply with us, we're not going to mandate that, not allow you to utilize your VA benefits because you have the eligibility to be able to still utilize them based off the certificate of eligibility. As long as we have the letter of explanation as to the reason why you're leaving your owner occupied residence to purchase another owner occupied residence, just like with any other program, VA typically does not have an issue with it, especially depending upon the circumstance.
So I got a question. Can you use the VA loan as like to buy a rental property? Because I got a friend that his parents gave him his house where he stays at right now, but he's also have VA loan eligibility. But can he use that as a rental?
That's a
You know what I
very
mean?
good question, and that's going to get us tied in probably to what we're going to talk about next with
Very
investment
good.
properties and all of the changes that are happening. VA is strictly for owner occupied residences. So they do have to occupy the residence for at least a period of a year. That's the requirement for VA.
Yeah.
financing.
Okay, very good.
So
Yeah.
I have a question as well. So I've got a VA and I'm looking at buying another piece of property in another area that we want to move to in the future. So I wouldn't have to sell or get rid of my VA loan on the current house. I could use it,
Correct.
the other one.
You could utilize it. You could utilize it depending upon your certificate of eligibility and how much you have left.
Well, you said that you said it's basically an unlimited loan amount now.
Correct. There's
So
no
what's-
purchase price limit. There's no purchase price limit.
So does that mean that the eligibility or the amount of the eligibility has gone up as well?
No,
No. So I would be limited as to how much of a loan I could get.
correct. Based on the certificate of eligibility, you would be limited to your loan amount. But if that's if you have, right? If you currently have a property. But also to go back to the question that you had asked, you do have to occupy the residence within a certain amount of time. So
The next, because I've been in this one for almost 3 years. So
okay.
that would, so I could use it as a rental and leave that loan in place and buy another house.
It's going to be
With the
very
VA?
difficult. It's going to be very difficult to find depending on where you're looking at buying, because depending on how much of your eligibility that you use on your current home will dictate how much you'll have of that. So like if you had 300,000, you're only going to be able to purchase, your purchase power is like 180,000. It's 36 times 4. So there's just a calculation that we do with VA to see how much eligibility that you have left. And it has to be owner occupied. So are you talking about a second home type of deal, or?
Well, it would be right now because we wouldn't be moving for another year.
Yeah, and you could, yeah, you couldn't do it as a second home. It'd have to be, you have to wait until you're ready to move.
And question from the group back here, funding fee. Is that, anything change with the funding fee?
Funding fees range from 0 if you're a disabled vet, it's 0. It's 2.14 if you're first time use, 3.3 if you're for a second time use. That's a good question, Patty.
Is there a disability rating? Can you be 10% or do you have to be 20, 30% for
You
0?
could be 10%. Any sort of disabled vet is waived. Good questions, you guys. So let's talk about, let's go into talking about the changes that are coming up. You know, investment changes are really big right now. Terry had a call last week. We had a manager's call about some upcoming changes that are happening. And it's going to be kind of really important for you guys to be aware of these changes. So right now, what happened? And it was 2008, right, Terry? Fannie, Freddie Mac became public, went away from being a private lender.
Right. And so what has happened is Fannie and Freddie are looking to go back into being private. So they are tightening up their guidelines. They've been doing this actually for several months. We keep getting updates that Fannie or Freddie tightened up their guidelines. What they have done now is they have limited, about 60 days ago, they limited how much of a portfolio a lender can have for non-owner occupied type loans, which is huge, right? And so we know whenever a bank wants to slow down the business, they increase the interest rates by quite a bit to slow down the refinance, right? They're inundated. They don't want any more refinances. Well, now Fannie and Freddie are doing the same thing. So a couple of months ago, they reduced that amount to a lender cannot have any more than 7% in their portfolio of non-owner occupied type loans, right? So that increased the interest rates by quite a bit and the cost, the points involved in it. And then again, 2 weeks ago, they raised it or lowered it again to the portfolio of 5%. That's huge, you guys. That is huge. The interest rates for non-owner occupied loans are so ugly. I can't even quote. Gems, we had one, right? And it was, the interest rate was terrible. It was like 4.75 and 3 points. Ridiculous, ridiculous. And so, and the only reason they're doing that is because they don't want to do these products. They figure we're in a bubble, or if we are in a bubble and they go down, the first homes to be foreclosed on or an owner to let go of a property is their non-owner, not their owner-occupied properties. Right.
Which is something they're seeing big time right now. It was released on the 13th of May 13th, 1.8 billion in debt that they're looking to sell right now, that are people that are bound to go into foreclosure real soon. And they're trying to get those off their books.
Yeah, they want those off their books before they go private. All right. So not only with COVID, we had that mess where people weren't making their payments, but we're starting to see the foreclosures coming in, right, guys? And it's unfortunate. So what we're seeing is higher interest rates right now. In the next 30 to 60 days, we may see Fannie Freddie completely get out of the market for doing loans for non-owner occupied. That is huge for you guys, right? I mean, because if you have investors out there that are wanting to be, we're going to be going to non-QM types of loans, which Evergreen is currently in the process of getting lenders on board that will do non-QM. That means non-qualified mortgage. So we're not subject to the Fannie and Freddie qualified mortgage fees and rate tests. right?
They're making it really difficult for us, you guys, to even qualify a client, to allow them the option to even buy because of our QM requirements. There are points and fees tests that we do. They just lowered it, but they hired rates, they hired costs, they lowered the points and fees cost that we have to run to even be able to do those types of financing. So even though I have a qualified client who can, you know, purchase with 15% down, that's the minimum down payment for an investment is 15%. They're not going to qualify because I can't get them to pass the points and fees test because the cost is so high on those loans right now. They're really trying to just get them completely off their books.
So it sounds like to me we're kind of going backwards again when it goes to the non-owner occupies, the no income qualifying and all of that. Do you know what the parameters are going to be, or what are they saying?
Well, it's kind of like, Michele, it used to be you couldn't do a non-owner occupied cash out. You could not do those, and those are available now. So we're actually going to end up seeing, you know, maybe a 25 or 30% down type of payment on those products. The interest rates are going to be higher, but the fees are going to be lower on a non-QM mortgage. Like you'll be looking at 6% versus 4 3/4 at 3 points.
Cost, yeah.
So they'll be able to do them. It's just, it's going to be more of a non-QM thing. And it's not in place right now, but if you do have a non-owner occupied buyer, it's going to be very difficult for them to be able to get into a loan because of the fees and interest rate tests that Fannie and Freddie currently has the lenders do. If you don't qualify, it's called a qualified mortgage. And if you, the fees and the rates are too high, Fannie and Freddie won't buy them. Luckily, Evergreen, services about 75% of their loans. So we're not having the problem as far as servicing goes when Fannie and Freddie do go private. So, we're lucky that way. But as far as the QM, we're going to, and we'll update you as the time comes. We're really telling our buyers that are, wanting to leave their current residence to purchase another one and be a renter, or if they're looking to pull cash out, it doesn't make sense. It doesn't make sense for them right now to have a higher interest rate, all of that cost, and to keep that home as a rental. It's better for them. We'll go back to you guys and tell you it's best if they list the home.
And you're talking 1 to 4 units with a small down payment, correct? Now, what if they're putting 30% down?
Well, even if they're putting 30% down, they're still going to have high rates and fees on it if they're buying non-owner occupied. If they're buying owner occupied in a one unit where they're renting out 3, they're going to get owner occupied rates if it's a 4-unit property.
So it would be okay. It'd almost be easier to get a commercial loan. It sounds like it'd be cheaper.
Yeah, I'm not a commercial lender, so I don't know what the requirements are.
And, a loan that's for 5 units or more. Yeah, for 5 units or more. I mean,
well, it's not into effect yet. It's just something that's coming down the road.
okay.
Is in effect is the cost, the rate.
So what kind of point structure are you charging now?
Right now, I priced one out for one of Jim's clients the other day, had a 740 score, 4.75 rate at 3 points.
4.75 at 3. Okay. What if they just went at 5%? Would there be no points? Can you?
Non-owner occupied, non-owner occupied, you have to at least put
15% down. Yeah.
No, what I'm saying is, if you went to a higher interest rate, could you get rid of the upfront points?
We can only go so high in rate.
I mean, if you went to 5% or something, could you eliminate one of the points or
so
totally?
that's where the QM, Steve, that's where QM comes into place, where we can only go so high in interest rates before we can't anymore. And then we have to. So
yeah, the higher your rate, the less the point.
Correct.
Yeah.
Right. So, but
that's what I mean.
5% on our rate sheets right now is not even an option. We can't even go to 5%. So we fail the interest rate points and fees test at that point. So 4.75 is the max that when she priced that out last week, that's the max rate we could give. And so we had to. There's no off-sheet pricing when it comes to these types of
Yeah,
programs.
it was 7 points for 4 1/4. It was ridiculous.
Yeah.
7 points for 4 1/4.
Yeah,
Yeah.
it was like, yeah. I
And
mean,
that's
I
why I
don't know.
say, go to 5%, the payment's not that much different, and we could get rid of a couple of the points.
Right.
Mhm.
Right. And that's where we were talking about the whole QM and how it's working. They lowered the QM, raised, the interest rates and the cost, the points and fees to do the loans, but the rates aren't high enough for us to be able to absorb the cost to be able to offer those programs to the client. So I might have a qualified client that can go to a 5% rate, but that might not be available because of the cost,
points and fees
because of
test.
the rate points and fees test.
Mhm. It's more difficult, but that's only for your non-owner occupied borrowers. They're looking to buy in a rental property.
Well, that's what I'd be looking at if I bought something to use as a rental for a year or two.
Yeah, Janet, I saw your question about the foreclosures. I'm not sure what you guys are seeing as far as foreclosures go, but they are coming. With Fannie Mae announcing 1.9 billion on the books of bad debt that they are trying to get rid of on the 13th, they're coming. With everything that the government put into place because of the protection for renters and people allowing for the deferment periods after September, we're gonna see a shift. We're gonna see something happen in the industry.
So short sales, I mean, this is something that you as agents want to start targeting is non-owner occupied properties to get those listings.
Right.
Because there will be short sales coming. Mhm. Any other questions on that?
I definitely appreciate all the little pointers there. So thank you so much. Obviously we haven't seen too many right now, but it is coming down the pike. I even talked with somebody at Wells Fargo where I used to work with the modification department. And they're like, oh my gosh, Michele, just get your team ready. That's why we did have those classes. And I'm so glad everybody kept up with them. So that's good. And just keep on the lookout for other classes that KWRI is putting on. So it'll support you guys, for the future. Definitely.
And I just want to tell everybody, thank you so much for all that participated in the police officers thing on Saturday.
Brian, that was amazing. Brian Conrad.
It was amazing, and it was a lot of work, and Brian did a great job, and I'm just proud that we were able to be a part of that because it was a big thing for the Stockton PD. They are very, very impressed with Keller Williams and the time and effort that it took to do everything that was actually done. Sometimes you don't know how much work goes involved, right, Des, and putting together events like that. Crystal, as well. It's a lot of work putting together events and things like that. So at a spur of the moment thing, the people that pulled together was impressive.
Yeah, that was so amazing. Yeah, and everybody who chimed in and from all of the offices, which is so nice, so nice to see. And that's KW, culture. Just at the the best place where we can be is always supporting people. So that's very, very nice. So yes, thank you, everybody.
Well, we'll log off and let you guys. If you have any questions, just give us a call, okay?
Hang on just for a second, if you don't mind, please. Okay, let's go back to VA because there's some people who've been texting me as well.
Okay.
So bottom line is it's easy. It might be a little time consuming, but it is a simple loan, correct?
Correct.
I wouldn't even put it under the category of time consuming, Michele. It's no different. It's the same amount of documentation required for, take out the FHA forms, insert the VA forms. And I did see, Crystal had asked, how do we break the stigma of VA? And yeah, I personally, every time I have a client.
¿Cómo está, don César? Buenos días.
every time I have a client that's I approve VA and they come back to me with a real estate agent or a change in realtor who's telling them, oh no, we need to do conventional financing. I can't get your offer accepted on a VA loan. It burns me because it is an amazing program. There's no difference. I mean, when it comes to the appraisals, health and safety issues are going to be required even for conventional. Yeah, you can write it as is, but an appraiser is still going to call out safety issues to be fixed, just like an FHA loan, just like a VA loan. There's really no difference. The main difference is going to be, it is required a termite report and clearance. That's it. Everything else is the same.
In the last 30 days, guys, we've had 3 borrowers that have left their real estate agents because he's pushing them to get conventional financing and not use their benefit. I can't imagine somebody telling somebody not to use their VA benefit, but there are agents that are out there doing that, and it's no service. It's no service to them. Putting 5% down and having a $300 mortgage insurance payment and not having to have one on VA, that's kind of huge. And now they're going to qualify for, a lot less because they have a $300, mortgage insurance payment going conventional versus doing their VA, right? And so, I mean, that's something that we don't want to do, but there's no harder work. And Crystal, as far as selling it, when you guys are putting in offers, if you CC us or your lender and have the lender go in and respond, show them the funds to close, show them the DU, and call the agent to say, I have a great buyer, they've been a veteran for this long, help them to sell that, because there's no turn times. If we as a lender need to help you get those offers accepted, that's our job. That's just our job.
Terry, sometimes realtors think that they see the loan and it's 100% financing, and they think they put it in kind of the same category as Cal, HAFA, or FHA, being less desirable than conventional. And I have to correct those agents all the time and say, no. This is a benefit that the veteran has earned.
That's right.
And as long as you can put it that way and sell it that way, it's a benefit the veteran has earned. It's not that they don't qualify. They're very qualified.
Absolutely, Patrick. And if the lender will just pick up the phone and call the listing agent, and let them know I have a very qualified buyer. I mean, most of our buyers, we get into underwriting even, before the offers are, they're out there, getting their offer accepted. And so if you can tell a borrower, and I would encourage everyone, if you have a VA buyer, go ahead and get it into underwriting that fast and just say, I have an underwritten approval. The appraisals are going to take about 10 days. That's the maximum allowed with VA, guys. That's faster than a conventional or FHA appraiser right now, right? It's 10 days on a VA. That's pretty fast. I mean, they, legally have a 10-day rule. Once that order is submitted, they have 10 days to get that appraisal back to us. That's faster than a lot of appraisers are doing right now. And so, going over that types of stuff with them, and it's just experience.
Terry, for clarification on that, because I know there's several of us on here that work with a lot of veterans. It's 10 days from the day the appraiser goes to the property that they have to then return the report, correct?
Not that I've experienced, Patty. I have heard lenders say that they have 10 days from the time that they've inspected the property to return that to us. But within a few days of them receiving it, I mean, our turn times, I have not seen a VA over 10 days, period. Okay. I have just not seen that.
And then another question from the field back here. I know we have, with the pest clearance, I have worked with several lenders on VA, and I know it has varied from lender to lender as to whether or not the underwriter will require a full Section 1, Section 2 clearance. It depends what's on Section 2, and yet almost always Section 1. Can you speak a little bit more to that?
Yes.
VA guidelines are very specific. If you pull it up on the VA website, VA requires all Section 1, all Section 2 to be cleared. And to answer the other question I was seeing pop up, a veteran cannot pay for the pest report. The lender can pay for it, someone else can pay for it. And it's not very much, it's like $175. I pay it all day long for my
And
client.
that's just for the cost of the report.
Mhm.
Is it negotiable in a contract for a veteran to pay for or do the repairs?
Yes, a veteran can do their own
Absolutely, it
repair.
is, Patty. You know it. It
Yes.
is. You can, but that's a misconception.
Wow.
You know, for the thing.
And I just want to piggyback on what Patrick said. You guys, this is truly an opportunity. If you're going to work with veterans, you know, being somebody who was in the military myself, these guys have earned it. That's exactly what Patrick said. And I can't echo that loud enough. It's our job to educate Crystal, you know, Crystal Jean, the other agent, as to like, look, this is a phenomenal loan and you're creating a wonderful opportunity for somebody who has served our country.
Right.
Tell me, what is it about a VA loan that you don't understand, right? That would prevent you from wanting to present this offer. So it's a great education opportunity.
Mhm.
You guys nailed it on the head right there. You know, I had to do it a couple weeks ago, and I talked a listing agent into accepting our offer because it had a cow half, and they're like, well, they don't have the money down. I go, he's got $50,000 in his bank, but he still earned this right, and this is still available to him. And if the appraisal comes in less, he's willing to pay the difference. So we're going to give him money to be able to help. And it, you know, there's no extra time. And I think that's a lot of where the misconception happens on these types of financing is every lender is different. You know, for us, you know, we've been first-time homebuyer specialists, VA specialists for, I mean, Terry's been doing this for like 35 years. I'm doing it for 18 years. So I'm just going to go off the 18-year mark, you guys. And when it comes down to it, it's like we're direct underwriters. Any program that I interview with, if I were to leave Evergreen, they have to be direct underwriter for the program types that I do. We have to underwrite everything inside. Then when I send a CalHAPA, it's just a sign off. It's one day. And it's on, you know, what the requirement is for each lender. Not every lender is delegated underwriting to do these types of programs or specialty programs, or they don't understand them, or they'll say they do them, they try to get them on, and then it's a learning experience for that lender. And so I think agents experience these types of things happen, and that's kind of where things have gotten, you know, their bad reputation, their bad names. But when it comes down to it, this is an opportunity. These are programs that are specifically available for first-time home buyers, for veterans, that need to be used. Even if they're a veteran and they can qualify for those first-time home buyer specialty programs that go behind them, we need to be doing the client the benefit of being able to receive those types of things.
Right.
I want to just say one more thing about this, because this just happened 2 weeks ago and it was very cool. So those of you asking about repairs and structures. So I've seen so many awnings with my veterans. Every time I see an awning, I'm like, oh no, VA nightmare. Usually they're full of dry rot. So ask your pest inspector, do you do inspections for veterans? I partner with a wonderful inspector who, when it's a VA loan, he looks at that property a little bit differently, and he gives me pointers on what I can do or change immediately, so he doesn't have to call it out on his report. I personally pay for all those inspection reports, and he substantially discounts me because he knows I'm doing that for our veteran. So their whole company really supports veterans. So find the right partner, is what I'm going to say. So what we did with this awning, I just got to tell you, because it was a funny story. It really was horrible. It needed to be replaced. And I said, well, the buyers really want to keep it though. They kind of want to restore it. So do I have another option, Mr. Inspector? And he said, as long as it's not touching the house, Patty, remove it from touching the house. So we just had some 2x4s, hoisted it up off the roof where it's no longer touching the house. It is now a detached structure, and he took it off my report and we got our clearance. So you got to get creative. You got to have the right partner.
Wow. That's great, Patty. That's great information.
Thank you so much, Patty. I appreciate it. You guys, anything else? Because I do want to wrap this up. It's already getting closer, you know, to 11 to 12 o'clock. I'm off here. So I just want to make sure. So ask the questions now. You have them here. Is there anything else?
I did have several of our agents in our office, Michele, so I wanted to bring this back up. As far as what our office or what our brokers are saying in regards to the masks within our office. Isn't it going off of Lendy now on what is the requirement and our standard? Are any of
So-
our brokers on?
Yeah, no, but we can go ahead and talk about what we talked about on Monday. So basically, you guys, it's going to be the honor system. It's you guys are all adults. If you haven't got your shots or your second shot, you need to wear a mask, right? So I'm not going to be patrolling. I'm not going to be asking questions. We are, no mask basically if you don't have if you already had your shots. And does anybody have any questions regarding that?
Michelle, we are still requiring agents to sign in so that if something does happen.
We are. It should be in all the offices already. Nothing's been pulled. So yeah,
right.
definitely sign in all the offices.
Michelle, isn't the governor coming out? Isn't the governor coming out with on June 15th, no mask for the state of California?
Right. But it's like inside and outside right now. You don't have to wear one if you've had your shots, right? So, but if you haven't had
It's
it,
an option. It's an option to wear one, right? It's
it is
not
an
that
option, of course, anything's an option, right? So, I mean, even with it's for their protection to wear a mask according to the news, right? And so, I'm not going to patrol this at all, and nor is Chris, and nor is Rachel. So. I'm sorry, Peggy. Let me look. Right, nothing's totally official, obviously, and it's going to change probably tomorrow. It's going to change in about an hour, I'm sure, and it is all new to everybody. So, yeah. Any other questions or comments? Okay, so I want to introduce you guys to somebody. Has everybody had a moment to meet Stephanie? Don't get all nervous, Stephanie. Your face is already getting red, so stop it.
Oh, that's great.
So let's do this. This is Stephanie. She's our new assistant MCA. So if you have a chance, stop by in Stockton to say hi. And Stephanie, do you want to introduce yourself?
I'm Stephanie. Nice to meet everybody.
She comes with an extensive background in accounting, and that's what we needed, right? That's what the MCA position is, and obviously customer service as well, because you guys are our customer, and we need to make sure we are there for you at all times, right? Crazy times, good times, all the fun times. So this is Stephanie. Everybody say hi. Awesome. Okay, you guys.
Hi, Stephanie. Hi.
Thank you so much, Stephanie. Anybody have any questions before we sign off? If there's anybody, thank you, Michael. If anybody has any suggestions for another team meeting, I know we're still looking for a really good appraiser to step in and just so we can ask some questions to them. But right now it's so crazy out there. I'm having a hard time trying to get one, right? So I had one line up, then actually Marissa had one line up, and so it's just been hard on everybody right now. But it's just an obstacle. So yeah, I'm trying to think. Okay, you guys did see the save the date for the Christmas party? Can I get a woo woo? I'm so glad. I don't know what happened that we just like chimed in to get the reservation because it was hard to get. So I'm so glad we all woke up one morning and said, let's just do it right now. And then I am working on our summer lake party. So I've actually texted her a few times. She knows we're interested, but she's behind the gun right now as well. So I'll update everybody once I have a date. All right, you guys.
Hey, real quick, Michelle, before everyone leaves.
Yes.
I have a new listing coming up, a triplex in Manteca. So if anyone's got any investors, it's going to be going on the market on Friday.
Awesome. And who is this? I can't.
This is Marie Plum, sorry.
Oh, there you, Marie. Awesome.
You have an address?
Yes, I am me, and I'll get it to you.
What price?
$650.
Thank you.
Hey, Michelle, I wanted to remind everybody that the brokers sent out an email regarding the June release of documents, revised and new documents in zip forms from CAR. So we need to make sure that we're paying attention to that and we're ready for it. Those are going live on June 21st. And if you have not seen the new RPA that's coming out at the end of the year, it's going to blow you away. So you need to spend some time. There are courses available. CVAR, as a matter of fact, on the 19th
Saw
of May.
that link, yeah.
Yeah, CVAR is doing the course, and they're only charging $50. If I was to go on to CAR and do it, it was $75. So CVAR, sign up for it the 19th of May.
Awesome. Okay, thank you so much. And then also the brokers will be having a disclosure class that's coming up on the calendar. I don't know off the top of my head, but so just look at the save the date and look at your intranet calendar. That should be emailed to you every single day. If it's not, that means it wasn't set up or there was an obstacle with it. So get with your front desk and they can set it up for you. Okay, and if you have any questions regarding VA, don't hesitate to give Marissa or Terry a call. All right, you guys, it's Monday. Go make it a great week. Thank you for everything. Bye.
Bye. Thank you.
Bye. Thanks so much for your time.
Of course. Anytime, you guys.